Job order costing, Chapter 19. Managers use cost accounting systems to plan and control. If the manager can calculate the cost of one unit of product, then he or she can use that information to plan a selling price that will produce profits for the company. In addition, this enables the manager to compute both the cost of goods sold on the income statement and the value of the ending inventory on the balance sheet. Once the cost per unit of product is known, the manager can plan and control those costs. Exhibit 19.1 illustrates several examples of unit costs. Note that unit cost information is used by all types of businesses, not just by manufacturers. This data is useful for service businesses and merchandisers as well. There are two types of cost accounting systems: job order costing and process costing. Job order costing is used by businesses that produce unique products or provide specialized services. Costs are accumulated for each batch or job. Examples of this type of company are accounting firms, music studios, healthcare providers, building contractors, or maybe custom furniture manufacturers. In contrast, process costing is used by businesses that manufacture large quantities of identical units. Production is carried out through a series of steps or processes, and costs are accumulated for each process. Examples of the types of companies that use process costing are soft drink manufacturers, whose processes may include mixing, bottling, and packaging, surfboard manufacturers, whose processes may include sanding, painting, waxing, and packaging, and maybe medical equipment manufacturers that are making blood glucose meters, whose processes may include soldering, assembling, and testing. There are 4 steps that are used to track product costs. These same 4 steps are followed whether we use job order costing or process costing. The steps are accumulate, assign, allocate, and adjust. These steps will be used as we follow how the product costs flow through the inventory accounts on the balance sheet to the cost of goods sold on the income statement. So for the try it, would the following companies most likely use job order costing or process costing? A paint manufacturer. Well, most paint is pretty much the same as the paint that went before or after it, so that's process costing. Print shops are very much a custom business, so that's probably going to be a caterer, again, is probably going to be type business, so job order costing would be appropriate. Soft drink bottler, someone who produces Coca-Cola, for instance, or bottles Coca-Cola. One bottle should be the same as the next. This costing might be appropriate. And yachts are probably not assembly line machines. They're probably custom built for the most part, so we would get job order costing. Exhibit 19-2 shows the flow of product costs through a job order costing system. It begins with the job cost record. As soon as a job is started, all of the direct materials, direct labor, and manufacturing overhead costs for the job are recorded on this job cost record. Here, Smart Touch Learning has started 3 jobs during the accounting period: Job 27, Job 28, and Job 29. Work in process inventory and finished goods inventory are asset accounts on the balance sheet. The total costs of each job are added to work in process inventory by debiting the account. When a job is finished, the company totals the costs and transfers the costs from work in process inventory to finished goods inventory. The costs transferred to finished goods inventory are called costs of goods manufactured. In this example, Smart Touch finished jobs 27 and job 28. When the job's units are sold, the costing system moves the costs from finished goods inventory, which is an asset on the balance sheet, to cost of goods sold, which is an expense account on the income statement. Here we see that SmartTouch sold all the units from job 27. Taking a closer look, we see that the ending balance in work in process inventory is the cost of job 29, which is the only job that is not complete and still in process at the end of the period. The ending balance in finished goods inventory is the cost of job 28, the only job that was completed but still not delivered to the customer. The ending balance in cost of goods sold is the cost of job 27, the only job completed and sold. We're now going to look at how specific transactions are journalized in a job order costing system. During 2016, SmartTouch purchased raw materials of $367,000 on account. Note, to simplify the recording process, we're recording the purchases as a summary journal entry for the year, rather than showing each individual purchase. The raw materials account had a beginning balance of $70,000. This is the product cost that accumulates in the raw materials inventory account. Raw materials inventory is debited to increase the asset account. Accounts payable is credited to increase the liability account. It is important to note that SmartTouch's raw materials inventory is the general ledger account. SmartTouch also has a subsidiary ledger for raw materials. The subsidiary ledger contains the details of a general ledger account, and the sum of the subsidiary ledger records equals the balance in the general ledger account. In this case, the raw materials subsidiary ledger would include a separate record for each type of material that SmartTouch Learning uses to produce its tablets. So, SmartTouch would have a separate page for batteries, processors, cases, and other materials used. Exhibit 19.3 shows an example of SmartTouch's raw materials subsidiary ledger for batteries. A subsidiary ledger allows for better control of inventory because it helps track each type of material used in production. Remember, the balance of the raw materials inventory account in the general ledger should always equal the sum of the balances in the raw materials subsidiary ledger. When SmartTouch started job 27 on January 14th, the production team requested materials for the job by filling out a materials requisition, as shown in Exhibit 19.4. The materials requisition is a request for the transfer of raw materials to the production floor. Note that the subsidiary ledger previously shown in Exhibit 19.3 records the materials requisition number 342, along with the number of units requisitioned and their costs. When raw materials are received on the production floor, they are recorded on the job cost record. Exhibit 19.5 shows the job cost record for job 27 after materials requisition 342 has been recorded. The raw materials added to job 27 from this materials requisition are considered direct materials because the batteries can be easily and cost-effectively traced directly to the finished tablet. SmartTouch will record a summary journal entry at the end of the period for all materials used. To produce the tablets, both direct and indirect materials are used. Remember, direct materials can be easily and cost-effectively traced directly to the finished product. Indirect materials cannot be easily and cost-effectively traced directly to the finished product. In 2016, SmartTouch used direct materials costing $355,000 and indirect materials of $17,000. Work in process inventory had a beginning balance of $80,000. To record the use of direct materials, the cost of the direct materials is transferred out of raw materials inventory and is assigned to work in process inventory. The amount debited to work in process inventory is the total of the individual job cost records. To record the use of indirect materials, the cost of the indirect materials is also transferred out of the raw materials inventory account. However, these costs are accumulated in the manufacturing overhead account with a debit to that account. Manufacturing overhead is a temporary account used to accumulate indirect production costs during the accounting period. Because it is a temporary account, it is classified as an equity account. We will show how manufacturing overhead is adjusted later in this presentation. Now that we know how to record the purchase and use of materials, we will take a look at how labor is recorded in a job order costing system. Exhibit 19.6 shows the job cost record for job 27. Direct materials have been recorded, as shown previously. Direct labor costs are assigned to the job based on labor time records. These labor time records may be obtained electronically when employees swipe their ID cards and enter job information, or they may be obtained from a manual system. In either case, the labor time record reports the number of hours worked on the job and the hourly wage rate, and then computes the total direct labor cost for the job. In this example, a Smart Touch employee worked 5 hours on job 27. The employee's hourly rate was $18 per hour. Therefore, the total direct labor cost is $90, which is calculated by multiplying the 5 hours worked by the $18 hourly rate. During 2016, Smart Touch incurred total labor costs of $197,000, of which $169,000 was direct labor and $28,000 was indirect labor. Recall that direct labor costs can be easily and cost-effectively traced directly to the finished product. Indirect labor costs cannot. Indirect labor consists of labor costs for employees working in the factory, but not directly on the products, including employees in supervision, maintenance, and janitorial positions. The total cost of direct labor is debited to work in process inventory. The indirect labor costs are accumulated in manufacturing overhead by debiting that account. This is the same treatment as the direct and indirect materials illustrated in Transaction 2. For this triad, record the following journal entries for Smith Company. Purchased materials on account, $10,000. So for this entry, we're going to want to debit the raw materials inventory account and credit accounts payable since it's on account. Used $6,000 in direct materials and $500 in indirect materials in production. So for this journal entry, we're going to want to debit work in process inventory for $6,000 and also debit manufacturing overhead for $500 for the indirect materials. We are going to credit the balancing amount there, or $6,500 from the raw materials inventory. Number 8 incurred $8,000 in labor costs, of which 80% was direct labor. So we're going to debit work in process inventory for 80% of $8,000, or $6,400, and we're going to debit manufacturing overhead for the remaining 20% of that $8,000, which is $1,600. And we're going to credit wages payable for $8,000. We've already accumulated the costs of indirect materials, Transaction 2, and indirect labor, Transaction 3, to manufacturing overhead. In the next few transactions, we will see that all manufacturing overhead costs are accumulated as debits to the manufacturing overhead account. Let's look at Transaction 4. Depreciation on manufacturing plant and equipment is $20,000. Manufacturing overhead is debited for the actual overhead cost of $20,000, and accumulated depreciation is increased with a credit of $20,000. In Transaction 5, plant utilities of $7,000 are manufacturing overhead is debited for the actual overhead cost of $7,000, and cash is decreased with the corresponding credit. Transaction 6, plant insurance of $6,000 that was previously paid expires. Manufacturing overhead is debited for the actual overhead costs of $6,000, and prepaid insurance is decreased with the credit for that same amount. In Transaction 7, plant property taxes incurred but not yet paid are $5,000. Manufacturing overhead is debited for the actual overhead costs of $5,000, and property taxes payable is increased with a credit. Throughout the year, SmartTouch has debited manufacturing overhead for actual manufacturing overhead costs as they occur. By the end of the year, the manufacturing overhead account has accumulated all of the $83,000 of actual overhead cost as debits. As you can see, overhead includes a variety of costs that the company cannot trace to individual jobs. For example, it is impossible to say how much of the cost of plant utilities is related to Job 27, yet manufacturing overhead costs are as essential as direct materials and direct labor. So SmartTouch must find some way to allocate overhead costs to specific jobs. Otherwise, each job would not bear its fair share of the total costs. To determine the amount of overhead to allocate to specific jobs, there is a three-step process that occurs at three different points in the accounting cycle. First, a predetermined overhead is calculated before the accounting period. Next, the overhead is allocated during the period. Finally, the overhead is adjusted at the end of the period. If we wanted to make the most accurate allocation of overhead, we could only do this when the total overhead cost was known, and that is not until the end of the period. However, managers cannot wait that long for product cost information. Therefore, a predetermined overhead rate is used to allocate estimated overhead costs to individual jobs. This predetermined overhead allocation rate is calculated before the period begins. The formula to calculate the rate is total estimated overhead costs for the period divided by total estimated quantity of the overhead allocation base. What do we mean by overhead allocation base? The allocation base is a denominator that links overhead costs to products. It is the primary cost driver of manufacturing overhead. In other words, a cost driver is the primary factor that causes or drives a cost. For example, the cost of electricity to operate machinery increases with increased machine use. Therefore, the cost driver for electricity is machine usage. So, the allocation base would be the number of hours the machine runs. There is a relationship between the overhead cost and the allocation base. That is, the higher the quantity of the allocation base, the higher the overhead costs, and vice versa. There are three cost drivers that are commonly used by manufacturers. Direct labor hours, or direct labor costs, are appropriate cost drivers for companies whose production is labor intensive. Machine hours are used when production is machine intensive. Let's take a look at an example of how this predetermined overhead allocation rate is computed. At the end of 2015, SmartTouch estimated that the total overhead costs for 2016 would be $68,000, and direct labor costs would total $170,000. We take SmartTouch's estimated overhead costs of $68,000 for the year and divide by their estimated direct labor cost of $170,000 for the year. The result is a rate of 40%. So how does a company allocate overhead costs to jobs? As jobs are completed, the company will use the predetermined overhead allocation rate to allocate overhead costs to the particular job as follows. The predetermined overhead rate will be multiplied by the actual quantity of the allocation base used by each job. Let's look at an example using SmartTouch Learning. The total direct labor cost for Job 27 was $1,250. To allocate overhead to Job 27, SmartTouch will multiply the predetermined overhead allocation rate of 40% by the actual direct labor cost for the job. The result is that $500 of overhead is allocated to Job 27. SmartTouch uses the same predetermined overhead rate to allocate manufacturing overhead to all jobs worked throughout the year, including jobs still in process at the end of the accounting period. Exhibit 19.7 shows the completed cost record for Job 27. The actual direct materials cost of $2,750, actual direct labor costs of $1,250, and allocated overhead of $500 are recorded for Job 27. As a result, the total cost to produce 15 tablets is $4,500, for a unit cost of $300 per tablet. Smart Touch's total direct labor cost for 2016 was $169,000, as seen previously in Transaction 3. This information is used to calculate the amount of manufacturing overhead to be allocated. Smart Touch allocated manufacturing overhead to each of the jobs worked on in 2016, including jobs still in process at the end of the year. We calculate the total overhead allocated to all jobs by multiplying the predetermined overhead allocation rate of 40% by the $169,000 direct labor costs. The result is $67,600 of overhead being allocated to the work in process inventory. Work in process is increased with a debit for the allocated overhead costs of $67,600, and manufacturing overhead is decreased with a credit. After Transaction 8, the manufacturing overhead account has a debit balance of $15,400. This means that Smart Touch's actual overhead costs of $83,000 were greater than the allocated overhead of $67,600. We say that Smart Touch's manufacturing overhead is underallocated because the company allocated less costs to jobs than actual costs incurred. Recall that manufacturing overhead is a temporary account used to accumulate indirect production costs during the accounting period. At the end of the accounting period, the manufacturing overhead account must have a zero balance. Therefore, an adjustment is required if overhead is underallocated or overallocated at the end of the period. We will show how to prepare this adjustment after we account for the completion and sale of the goods. For this try it, Smith Company expected to incur $10,000 in manufacturing overhead costs and use 4,000 machine hours for the year. Actual manufacturing overhead was $9,700 and the company used 4,250 machine hours. Calculate the predetermined overhead allocation rate using machine hours as the allocation base. So we have $10,000 divided by 4,000 machine hours for a rate of $2.50 per machine hour. How much manufacturing overhead was allocated during the year? 50 cents per machine hour times 4,250 machine hours, for a total of $10,625 allocated during the year. Let's review the flow of costs through the accounts. Exhibit 19.8 shows the flow of costs of 3 jobs at Smart Touch: Job 27, Job 28, and Job 29. When Job 27 and 28 were completed, their costs were transferred from work in process inventory to finished goods inventory. The amount transferred is the cost of goods manufactured. The ending balance in work in process inventory is equal to the costs of partially completed Job 29. Looking next at the finished goods inventory account, we see that Job 27 was sold and its costs were transferred to cost of goods sold. Therefore, the ending balance in finished goods inventory is equal to Job 28, which is the only job completed but not sold. The balance in cost of goods sold is equal to the costs of Job 27, which was the only job sold. Following this flow of costs through the accounts, we next look at how to account for the completion of jobs. Normally, this entry would be made as each individual job is completed, but we are showing it as one summary journal entry, Transaction 9. The cost of goods completed during 2016 is $644,600. This is the cost of goods manufactured. The amount must be transferred from work in process inventory to finished goods inventory as jobs are completed and moved into the finished goods store. To accomplish this, finished goods inventory is increased with a debit of $644,600, and work in process inventory is decreased with a credit. Transaction 10 records $1,200,000 of sales on it. The asset accounts receivable is increased with the debit and sales revenue is increased with the credit. Transaction 11 records the $584,000 cost of all jobs that were sold in 2016. Cost of goods sold is increased with the debit and the asset finished goods inventory is decreased with the credit. To summarize the flow of costs through the accounts when jobs are completed and sold, we look at the work in process accounts, which are assets on the balance sheet, and cost of goods sold, which is an expense on the income statement. As jobs are completed, their costs are transferred from work in process inventory to finished goods inventory. The $27,000 ending balance in the work in process inventory account represents the cost of jobs started but not finished at the end of the period. The cost of all jobs sold is transferred from finished goods inventory to cost of goods sold. The $60,000 ending balance in finished goods inventory represents the cost of all jobs that are completed but not. For this try-it, the following information pertains to Smith Company, which you worked with previously in this chapter. Number 11, Smith Company completed jobs that cost $25,000 to manufacture. Record the journal entry. So this would be a debit of $25,000 to finished goods inventory and a credit of works in process inventory. Number 12, Smith Company sold jobs to customers on account for $52,000 that cost $22,000 to manufacture. Record the journal entries. So there's going to be two journal entries here, one reflecting the internal costs and one reflecting the revenue received. So we're going to have $52,000 debit to accounts receivable and a credit of $52,000 to sales revenues. And then we're going to have a debit of $22,000 to cost of goods sold and a credit of $22,000. The last step of recording costs in a job order costing system is to adjust the manufacturing overhead account for the amount of overallocated or underallocated overhead. The total debits to the manufacturing overhead account rarely equal the total credits because overhead is allocated using a predetermined overhead allocation rate based on estimates. At the end of the accounting period, SmartTouch has a $15,400 debit balance in the manufacturing overhead account. When there is a debit balance in the manufacturing overhead account, we say that overhead is underallocated because the manufacturing overhead that was allocated to work in process inventory was less than the actual overhead cost for the period. If there is a credit balance in the manufacturing overhead account, we say that overhead is overallocated. This occurs when the actual manufacturing overhead costs are less than the allocated manufacturing costs. At the end of the accounting period, the underallocated and overallocated overhead is adjusted by closing the manufacturing overhead account. Closing the account means zeroing it out. In order to bring the balance of SmartTouch's manufacturing overhead account to zero, we need to credit the account. The debit portion of the entry increases the cost of goods sold account. The underallocated overhead indicates that SmartTouch undercosted jobs by $15,400 during the year. The costs flowed through work in process inventory, finished goods inventory, and ultimately were transferred to cost of goods sold. Therefore, the adjustment is made to cost of goods sold. After transaction 12, the manufacturing overhead balance is zero, and the cost of goods sold is up to date. Exhibit 19.9 summarizes the accounting for manufacturing overhead. Before the period, the predetermined overhead allocation rate is calculated by dividing total estimated manufacturing costs by total estimated quantity of the overhead allocation base. During the period, manufacturing overhead is allocated by multiplying the predetermined overhead allocation rate by actual quantity of the allocation base used by each job. At the end of the period, an adjustment is made for any overallocated or underallocated overhead. If actual manufacturing overhead costs were greater than allocated manufacturing overhead costs, manufacturing overhead is considered underallocated and the cost of goods sold is undercosted. To close manufacturing overhead, cost of goods sold is increased with a debit and manufacturing overhead is decreased with a credit. If actual manufacturing overhead costs were less than allocated manufacturing overhead costs, manufacturing overhead is overallocated and cost of goods sold is overcosted. To close manufacturing overhead in this case, manufacturing overhead is increased with a debit and cost of goods sold is decreased with a credit. As costs flow through the job order costing system, we go through a four-step process to accumulate, assign, allocate, and adjust. Exhibit 19.10 is a list of all journal entries illustrated in the chapter with notations on the four steps. Exhibit 1911 shows the schedule of cost of goods manufactured for Smart Touch for 2016, as shown previously in Chapter 18. Exhibit 1912 shows the income statement for the same period as shown previously in Chapter 18. For this triad, the following information pertains to Smith Company for the year. Estimated manufacturing overhead is $500,000. Estimated direct labor hours, 10,000 hours. Actual manufacturing overhead, $550,000. Actual direct labor hours, 10,500 hours. Calculate the predetermined overhead allocation rate using direct labor hours as the allocation. So we have 500,000 divided by 10,000 direct labor hours for a $50 per direct labor hour rate. Determine the amount of overhead allocated during the year. Record the journal entry. So we take that $50 per direct labor hour rate, multiply it by actual hours of 10,500, $525,000. So we will debit that amount to work in process inventory and credit it same amount to manufacturing overhead. Determine the amount of underallocated or overallocated overhead. Record the journal entry to manufacturing overhead. So we take the allocated overhead, and we're left with $25,000 that were not allocated but were actually incurred. So, in order to alleviate this underallocation, we will debit cost of goods sold for $25,000 and credit manufacturing overhead for $25,000. Because service firms have no inventory, these firms incur only non-inventoriable costs, but their managers still need to know the cost of different jobs in order to set prices for their services. Using a law firm as an example, direct labor costs would be traced to a specific job, in this case a client, through a labor time record, just as was done in a manufacturing company. A predetermined overhead allocation rate is calculated the same way that we did for the manufacturer Smart Touch Learning. First, total indirect costs are estimated. Walsh uses direct labor hours as the allocation base because direct labor hours drive overhead costs. The estimated overhead of $300,000 is divided by 10,000 direct labor hours that are estimated to be worked in 2016. The overhead allocation rate is $30 per direct labor hour. We determine the total costs assigned to client 367. 14 direct labor hours are worked on client 367's case, and the hourly rate for direct labor is $50 per hour. The total cost of working on client 367's case, we add the direct labor costs and the allocated indirect costs. Multiplying the 14 direct labor hours by the $50 hourly rate, we see that the cost of direct labor was $700. To calculate the allocated indirect costs, we multiply the 14 hours by the $30 predetermined overhead allocation rate for a cost of $420. Therefore, when adding together, the total cost of this job was $1,120. Once a service company has a good estimate for total job costs, it is better prepared to make pricing decisions. If Walsh Associates desired a profit equal to 75% of the firm's costs, it would use the following formula to determine the amount of the markup: total cost of the job multiplied by the markup percentage. For Walsh, the markup would be $60 per hour. To determine the price charged, the markup would be added to the total cost of the job. In this example, Walsh would need to bill its clients $140 per hour to earn the desired markup. Wesson Company is a consulting firm. The firm expects to have $45,000 in indirect costs during the year and bill customers for 6,000 hours. The cost of direct labor is $75 per hour. Calculate the predetermined overhead allocation rate for Wesson. 5,000 divided by 6,000 hours, and we get $7.50 per billable hour. Wesson completed a consulting job for George Peterson and billed the customer for 15 hours. What was the total cost of the consulting job? Well, we would take the direct labor hours of 15 times the $75 per billable hour, and that would give us $25. Then we would take the indirect costs and take 15 billable hours times the rate we figured out of $7.50, and that would give us $112.50 for a total cost of $1,237.50. If Weston wants to earn a profit equal to 60% of the cost of a job, how much should the company charge Mr. Peterson? 60% of the cost, so 60% times $1,237.50 equals $742.50. We would then add that $742.50 to the cost for a total of $1,980.